Guys, the market got hammered again today. Stocks are falling everywhere, and some of the biggest names just reported earnings today. Amazon and Apple both released their numbers, and the market is reacting very fast. Chipotle got crushed after yesterday. Even Sprouts Farmers Market, the grocery store, tanked big time today. So what's going on? Why is the whole market falling, and what's behind this volatility? Stay tuned, because we're going to break it all down and make sense of this crazy day in the market. So stocks fell hard today. As you can tell, S&P down 1%, Dow down 0.3%, NASDAQ down 1.6%. At one point today, the S&P and the NASDAQ were both down while the Dow was up. Now, what happened? Well, yesterday, Meta and Microsoft both reported, and they were down big time. They beat on earnings and revenue both, but their futures were not as bright as people wanted to hear. Meta had some one-time charges that knocked them in the negative. People are upset about that. And so people took it out on tech. As we've said before, what has led this market up is what's going to be taking the market down. That's why you see such a big drop in the NASDAQ relative to the S&P. That's what's going to happen if we have a bear market. Hypothetically, if the S&P were to fall 25%, my guess is the NASDAQ would fall 40%, if not more. Over 40%, because what leads the market up is going to be the most overvalued stuff. Is what's going to drag it down. That's very important for you to understand if you're new to this channel. So Amazon just reported, guys, they crushed it. So before I give you the number, let's see if the stock is up or down. The stock is up big, 8.8%. They reported 1.82 billion in revenue versus 180.2 billion in revenue versus 177.8. But they reported earnings per share of $1.95 versus $1.57. If this holds up, will lead tomorrow greatly into the positive. Why? Because Amazon's one of the most valuable companies in the S&P and the NASDAQ. So it's going to drag everything up along with it. That's very important to understand. Now, keep in mind, it was down 3.22% today. So it's more than made up for those gains. And Amazon, surprisingly, is not up a ton over the last 5 years. It's had a little bit of a wild ride, even though the business has gotten better. This is what we always talk about. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Let's go pull up Amazon's earnings release to see what they had to say. Guys, for a company as large as this, net sales rose 13% to $180.2 billion. Just like yesterday, Microsoft went up 18% of revenue. Guys, I'm not going to lie. Those are big numbers for such a large company. That's not easy to do. That is something to really look at here. So they did $180.2 billion versus $158.9 billion. That excluded that there was a $1.5 billion favorable impact from foreign exchange rates. When foreign exchange, like currency things, fluctuate and change, it can be a headwind or it can be a tailwind for these companies. Operating income was $17.4 billion, exactly the same as last year. So operating income shows how the business is doing fundamentally. The North American segment operating income was $4.8 billion, down from $5.7 last year. Without the charges being done here for the FTC, there were two big charges. They would have done 21.7 instead of $17.4 billion in operating income. Let's go see. Oh, wow. Free operating cash flow up 16% and free cash flow increase, driven primarily by increase of 14.8. Oh, decrease. There you go. Free cash flow decreased by 14.8 billion. Okay. Free cash flow is cash from operations less your capital expenditures. Amazon is spending a ton more on capital expenditures. I would not focus on free cash flow for Amazon right now, which is a very different tune than I've had in years past. They have deliberately invested more into growth. Doesn't mean you should understand that growth is going to yield big results. But what it means is don't just focus on that free cash flow. Focus on the operating income. Make sure that you understand how they're making money. Let's continue on here. And guys, another big one, AWS sales increased 20% year over year to $33 billion. I believe Microsoft was up like 28% or something like that. And Google's was up 18% maybe. So a little bit higher than Google. And I'm going off memory here, so I don't remember exactly what it was. But this is a very high margin business, and they're the leaders in this. Our software is driven by AWS. Our software here that some of you guys are members of, driven by AWS. Okay, so another thing, guidance. Net sales are expected to be between 206 and 213 billion, which is a 10 to 13% growth versus fourth quarter last year. Okay. That anticipates a favorable impact of 1.9% on foreign exchange rates. Operating income is between 21 and 26 compared to 21.2 last year. So almost in line, but they'll probably beat last year's numbers. And guys, today at 5 p.m. Eastern time, it might be the start of this video, they'll be doing their call. So let's see what they're doing now. Still up 8%. Wow. Let's look at Amazon from a perspective of what our value is. And guys, don't forget, we're still going to do Apple here shortly. We're still going to talk about Chipotle and Sprouts Farmers Market. So stay tuned here. But here is my analysis on Amazon, my very high level 10-year stock analyzer tool number. Revenue growth 4, 7, and 10%, which seems low when they're growing 13% or more, but this is for a 10-year period. Profit margin of 8, 12, and 16, which keep in mind, guys, 12 and 16 are my middle and high numbers, and they've never done that. So I'm giving them more growth in that profit margin. And my PE and price of free cash flow 10 years from now, 2023 and 26, with a 9% intrinsic value return. I'm not putting any margin of safety in. I'm just saying, what do I think this company is worth? I hit the analyze button. So it's a little bit harder. We're at 100 on the low side, 376 on the high side, 203 in the middle. So we're quite a ways away from that 240 number it's at right now. It's now up 9%. Guys, I've gone through a lot here on Amazon. I want to remind everybody that this is a great company, but our goal is to pay great prices for these great companies. Now, of course, the Warren Buffett and Charlie Munger method is to say, I'd rather pay a fair price for a great business than a great price for a fair business. I believe it's possible to pay a great price for a great business. That usually happens when the entire market is kind of dragged down. We're not in that stage right now. Amazon has a lot of great growth potential. They have a lot of great earnings potential. If you go look at analyst estimates, they expect to double their profit essentially per share in the next 4 years. That's a lot of earnings potential, guys. You can't ignore that. You've got to give them a premium because it's a premium company. Don't ever forget that. All right, guys, Apple just reported EPS of $1.85, beating expectations of $1.75, revenue of $102.5 billion, beating expectations of $101.8 billion. Let's see how the stock is doing right now. It is down 1.5%. It was down 2.5% at one point recently. Wonder why that is. Are people expecting better? This is what I talk about. It's a crapshoot here. We don't know what's going to happen on any given day. We just sat there and reported Amazon, and Amazon is currently up 9.26%. Apple hit $4 trillion market cap right ahead of earnings. Now it's only down. It's fluctuating, and they're going to have an earnings call. The interesting part is I'm not seeing their earnings release on their website. It's not popping up here. Wonder why that is. They have not given the press release yet, and I'm trying to figure out why that is because I want to see how their iPhone 17 sales are doing. So just bear with me for 1 second. So guys, they reported quarterly revenue up 8% year over year. Can I explain to you how impressive that is that a company this large, all these companies, Microsoft, Google, Amazon, Apple, growing revenue at this kind of rate? I know 8% doesn't sound like a lot, but that's impressive. Earnings per share up 13% year over year. Today, Apple is very proud to report a September quarter revenue record of 102.5, including a September quarter revenue record for iPhone and an all-time revenue record for services. Why are services so important? Guys, services are high margin business. Right now, Apple is mostly a hardware business, so it costs a lot of money to make this stuff. But with services, it's software driven. So it's a very high margin business. So it's the kind of business as they grow that, their revenue can grow reasonably, but their profit will grow even faster. That's the key for services here. Our September quarter results capped off a record fiscal year with revenue reaching $416 billion, as well as double-digit earnings per share growth. Apple's board of directors has declared a cash dividend of 26 cents per share of the company's common stock. The dividend is payable, blah, blah, blah. So here's a little breakdown here. September to September, and then the 12 months here. Products, $73.7 billion versus $69.958. Services, $28.75 versus $24.97. Cost of sales, as you can tell here, the products are $47 billion cost on $74 billion in revenue. Okay, so what is that percentage? That is 60% cost, 65%. But look at services. $28.75 billion in revenue, $7 billion in costs. That's 25% costs, 75% margin. That's why it's important they drive this up. That's the key for Apple's growth going forward. If you have two products, one has 40% margin, one has 75% margin, which one do you want to sell more of? That's what Apple's going to focus on here. That's a big key for them. Now, sales by segment, China was the only one that saw a decline from $15 billion down to $14.5 billion. And here are your iPhone sales, $46.2 billion to $49 billion. Mac increase, iPad barely an increase, and wearables and home accessories actually down slightly, and services were up significantly. We've been talking about this. If you go look at our past videos on Apple, every time we do an earnings release, we talk about these services because these services are high margin. It's like the AWS for Apple, but it's their home services. I belong to Apple One. I pay $38 a month or whatever it is to get Apple One. These are the things that are going to grow Apple's profit when revenue probably won't grow as fast. If they're able to get 10% revenue growth on services, 7.5% of that's going to be profit. If they get 10% revenue growth on products, 4% of it is profit. That's the big key there. So now Apple is up 1%. That's interesting. So let's go to our stock analyst. Let's see what analyst estimates are saying first. Well, this is how they're going to get this kind of double-digit growth on earnings per share. Like I said, these services levels going from $7.50 to $12.36 per share. That's a big thing for them. They got to really focus on that. And look at their revenue growth. Not that much. So the revenue growth of 5 or 6%, but their profit growth is 10% plus. Why? Services. You got to focus on those services. Absolutely have to do it. So what is this stock worth to us? Let's check it out right here. We're going to pull up Apple in our stock analyzer tool. Here are the last assumptions I did on Apple. And guys, look at these returns on capital. 38% in the last 10 years, 50% in the last 5 years, 61% in the last year. This isn't literal. They literally cannot invest $100 billion in their business and generate an extra $60 billion a year. But what it does tell us is this is a moat business. This is a great business. That's the key here when looking at these numbers. So I did 3, 6, and 9% revenue growth in the next 10 years. I did 24, 26.5, and 29% profit margin, factoring in services getting better, 20, 23, and 26 for PE and price of free cash flow, and my 9% desired return. So I hit the analyze button, guys. My value for Apple is a low of 120, a high of 277, a middle price of 182. So it's just expensive for me. That's fine. We're here to be patient. Chipotle stock. Look what it did today. It is down 18.5% today. The company cut its full year forecast for same-store sales. At least 5 Wall Street analysts have lowered their price targets. Let me show you this, guys. Here's some interesting things here. In the third quarter, Chipotle's same-store sales rose 0.3%, but the chain's traffic fell. While many restaurant chains have suffered as diners racked up by inflation eat out less, analysts were unsure of the chain's value perception contributed to Chipotle's issues. While its burritos and bowls average about $10, consumers often assume its average prices are closer to $15 for the fast casual peers. So is there a perception problem? When I go to Chipotle, guys, my order is $12.85. I get a bowl with chicken, fajita, a little bit of corn, a little bit of cheese, mild salsa, and white rice, and I get a large drink. It's $12.85 every single time. Now, people's perception is $15, so it might get people less to go. You can have same-store sales rise with lower foot traffic. Why? If prices go up. That's the other thing to remember here. CEO Scott Boatwright said that diners are visiting less frequently, particularly those between the ages of 25 and 35, a key demographic for the company. Same-store sales have worsened so far in October, and the company is now projecting that sales at restaurants open at least a year, the same-store sales, will shrink in the fourth quarter and fall by a low single-digit percentage for the full year. We are very concerned that the menu and marketing actions taken so far have not sufficiently offset the traffic retraction. So, guys, I'm going to ask a question. Do you think Chipotle will be here for the next 20 or 30 years? If the answer to that is yes, I asked the question, do you think they're going to make more money or less money 20 or 30 years from now than they do today? If the answer to that is more money, then my final question is, what's a reasonable price you can pay today that gives you a good return on the capital you're going to invest for that projected future. That's what we're trying to do here with investing. Yes, it's easy to look at 18% fall in a day and get scared, but I want you to use that to your advantage. I want you to sit there and say, everybody else is freaking out. This might be an opportunity. Could there be a temporary issue because of economic things? Sure. But does that mean it's going to be bad forever? Come on. I'm quite sure we're going to wake up 20 years from now and Chipotle's profit is going to be significantly higher. My guess is it could be 4 or 5 times higher. So if you look at this, the stock is down 42% over the last 1 year, 45% year to date. It's only up 35% in the last 5 years. That's pretty impressive. 25, I mean, everything is negative. 1 day, 1 week, 1 month, 3 months, 6 months, year to date, 1 year. All negative. We like this. This is an opportunity to see, is the market missing something? Let's see what analysts think about the company. Earnings per share more than double in the next 4 or 5 years, from $1.23 a share to $2.39. And revenue still growing. Because remember one thing, even if same-store sales are down, if they're opening more locations, that can still increase sales. I'm not saying it excuses same-store sales being down, but you can still grow as a company while you wait for the economic things to happen, and you can grow same-store sales again. But to think that same-store sales being down means you shouldn't buy the company, unless you think it's a permanent thing and it's on its way down forever, like Kmart was or Sears, that's not the thing to do. You have to wonder, listen, anybody who's watched this channel before knows I love Chipotle. I go to Chipotle as often as I can. It's such a great place to eat. I used to have Chipotle. There were several times I had Chipotle several times a day. I had it definitely every week, 4 to 8 times a week. There were several times I had it 2 or 3 times in a day. I love it. I'm biased. I will say this, though. I think the service at Chipotle has gotten worse in some areas. And I don't like doing online because I think it's inconsistent portion sizes, which is always an issue at Chipotle. But let's go see what we think Chipotle could be worth as a company, because it is down 40-some% year to date. So I did a 10-year analysis here. I did 5, 9, and 13% revenue growth. Profit margin, 10.5, 12, 13.5. PE, 18, 22, and 26, and a 9% intrinsic value return. So I hit the analyze button. My price is a low of 18, a high of 55, middle price of 32. We're almost there. You got to keep in mind, guys, this thing was, oh, Paul, you're crazy. It's not going to be down to $32 a share. It was at what earlier this year? 50 something a share? How high was it? What was the high in the last year? $66.74. All-time high of $69 back in June of last year. It is down over 50% from its 52-week high in December of last year and from its all-time high back in June of last year. This is a company to pay attention to, in my opinion. I don't want you to be the investor who says, I need to have this company. I want you to be the investor who says, I need to have the right price at the right value. That's what I want you to do. So guys, you've seen me use the stock analyzer tool. You've seen me use the analyst estimates. You've seen me use a fraction of the things this website does, and the community hasn't even been touched here in any of these videos. If you're new to our channel, keep watching, keep learning. If you've been here a while and you're ready to up your investing game to the next level, join the community, start your 7-day trial below, the link below. It's a 7-day trial, let you try it out, but I'll tell you right now, 83% of the people who try our 7-day trial pay for the full year. There's a reason for that. So go check it out. Love to see you in the community. Thank you for your time.